Monster Energy, if you got in the IPO of Hanson's back in 1990 when they reorganized into the IPO, 200,000% return over the last 34 years. It's the best performing stock in the entire S&P 500 is an energy drink company that created a new market. That's how the energy drink market came to be. I think if you've been drinking coffee your whole life, you're probably still going to drink coffee and you're not going to go to an energy drink. It's just a different product. At the end of the day, it's caffeine, but you're not going to drink something that's super sweet if you've been just drinking black coffee for the last 30 or 40 years of your life. Maybe the takeaway, if we can frame it this way, Kelvin, is that investing is kind of a combination of three principles. It is,
Welcome to Me and the Celsius, a stock that looks great on paper, but contains so many red flags that maybe an average retail investor probably wouldn't be able to see.
From being super bullish on Celsius a month and a half ago to really changing my mind, and now I've changed my opinion. I've sold all of my personal holdings. And what you said nailed it. The first layer, the second layer looks great. Earnings look great. The fundamentals look great. The investor presentations, the annual reports, it all looks great. But then as a long-term investor, as somebody who wants to hold a stock for 3 years or longer, every time I buy something, I started noticing some real problematic red flags.
Welcome to Me and the Market Goliath podcast. I'm your host, Kelvin, and I'm really excited to bring one of our favorite guest speakers back, Simon Erickson from Seven Investing, to talk about a lot of different things, but particularly the energy drinks industry or the caffeine industry. So I'm really excited to have you again, Simon. How are you doing?
I'm doing great, Kelvin. Being with you on this podcast is always one of my favorite of the year. You always ask great questions. We're totally aligned in helping long-term investors. Looking forward to talking about energy drinks here this morning.
The energy drinks industry is a very exciting or interesting industry to look at, mainly because energy drinks businesses are generally easy to understand, and it can really give a lot of insight into the general appetite for discretionary consumer beverages. Surprisingly, the energy drinks industry can reap high profit margins, which we'll talk about a particular stock that you've talked about recently in your newsletters. But before we talk about that, I want to deep dive into your investment philosophy, just as a refresher. First off, what does investing mean to you?
Well, it's really important, Kelvin. This is something that opens doors for your future, right? If you want to retire, you probably should be investing some money. Every year we've all got expenses. We work to pay those expenses. But if we're never saving any money, then we're going to continue working as long as we have to keep paying for those things. Whereas if you're just saving a little bit of money each and every month or each and every year and having that compound faster than inflation, you're generating wealth, you're building wealth. And that kind of gets you to the finish line of whether you want to retire early, whether you want to buy another house, whether you want to put your kids through college, whatever it might be. The whole point of investing is for our future. And what we have to do, even on top of that, is it's fine to just buy the S&P 500 if you want to, or, buy the Magnificent Seven if you want to, the largest companies out there. But for people like myself and for you, we like to go out there and hunting and find the opportunities that we think are going to return even higher than that. Don't want to just park your money away in cash. Don't want to just park your money away in bonds or even the S&P. I want to go out and find stocks that I think are going to return at least 15 to 20% a year, if not more than that. Now, you're not always going to bat 100%, when you're finding those, but it is over time, the market tends to reward those who do their homework. And that's kind of the whole foundation of Seven Investing and how long-term investing works.
What aspects of the company do you care about? Because previously we had multiple conversations in regards to looking at innovative companies. We talked about a barbell approach where you want to have a offensive and a defensive mindset when you search for stocks or companies. What kind of qualitative aspects or financial metrics that you look at and gets you really interested to study more about a company or a stock?
Yeah, everything you just described is the type of investor that I am, which is a fundamentals investor, right? We look at things like margins and revenue growth and operating leverage and all of those. There's a bunch of different ways to be an investor. Some people are technical traders. They'll look at charts. Other people are looking strictly at valuations and making decisions off of that. The most important things for me, it depends on the type of investment. Like you said, are we playing offense Are we playing defense? But for the growth style investing, it's got to be top revenue growth, top line revenue growth, operating leverage. So operating profit is improving over time as it's recognizing, efficiencies in its business, and then free cash flow generation, right? If you've got those three elements, it's kind of the validation that your market's growing as a whole, you're capturing your part of this market, and then you're generating cash flows for the good of your investors. The three of those are probably the building blocks that everything else comes afterwards.
While I was preparing for this podcast episode, I do believe that your personality traits affect how you pick stocks or select companies. So how would you describe your personality, Simon?
Uh-oh, gosh, you want to ask that or ask my wife or my kids? We're all going to have different answers, I guess. I would say I'm a cautious optimist. If you asked me this question 10 years ago, I would just say optimist. I look to the future, go to technical conferences, get excited when PhDs are talking about the cutting edge stuff out there. But I've also become very respectful of the hype cycle. And sometimes there's just way too much expectation into these growth businesses, right? Whether it's 3D printing or cannabis or immuno-oncology, whatever it might be, mixed reality, things like this tend to be short-term overvalued, long-term undervalued. They get there, but it takes time. And so as investors, we have to be careful about not getting too early into things that are really going to end up changing the world. But I do think that progress happens. I'm a real big believer in disruptive innovation, and the companies every year are trying to get themselves a little bit better at whatever it is they do. And then there are these newcomers that are doing things on a completely different set of rules that don't have public shareholders, maybe, that don't have the same requirements or conditions of the business that allows them to think differently. And a lot of times that's what disruption happens. It's just a newcomer comes in, flips the script on whatever industry you're in, and all of a sudden everybody does things differently. We've certainly seen that with the internet, with cloud computing, with AI here now recently.
So I do want to jump right into the energy drinks industry. I have so many questions because last time we talked about Domino's Pizza, whether the industry is easy or hard to disrupt. And I think there's a general consensus that the pizza industry is difficult to disrupt. I want to apply that question to the energy drinks industry, whether it's easy to disrupt or difficult to disrupt. And obviously, we're going to talk about a particular energy drink stock that has been pretty much beaten down the last couple of months. Huge drawdowns. We're talking about 60% from all-time highs. And the stock that we're going to talk about is Celsius, ticker CELH. I'm really excited to get your view in terms of the energy drinks industry, whether you're bullish or bearish. Take it away, Simon.
I mean, it's a molecule, right? This whole energy is based upon one molecule, which is caffeine, which we all need to get through the day. When you're drinking coffee in the morning or drinking energy drinks in the afternoon, really, it's hard to disrupt caffeine. And I think that's going to be around for a long time. It's just the form of how we're taking it and how much we're willing to pay for it. And I think that the nature of your question of the energy drink industry is really just the beverage industry, specifically the caffeinated beverage industry, where there are considerations that you have to think about, brands, what's selling and what's not selling, what's market share look like. But at the end of the day, I think that we are still going to be needing caffeine throughout our day. And I'll say, Kelvin, just before we jump into this, I'm really excited about this conversation with you because probably as recently as 3 months ago, I wasn't even that interested in Celsius. I just kind of thought it was another energy drink player, And then I started digging deeper and deeper and deeper, and I started to find out some of these unique qualities and the unique parts of this investment that now is really just got me very excited about it. But in full transparency, if you asked me this a quarter ago, I would have gone with a completely different stock. I'm an opportunist, though. I find opportunities in the market when they present themselves.
So before we deep dive into the financials and the overview of the company, the whole sector, do you like the taste of Celsius?
I have one about every other day, right? And I've tried all of these. I went out and did my diligence and went to the grocery store. And locally here, I don't know if it's the same for yours or for anybody who's listening, but like grocery stores are completely under attack by the energy industry right now. The entire front section of our grocery store is energy drinks. There's Monster, there's Red Bull, there's Celsius, there's C3, there's C4, there's Bang, there's Rockstar. It's like this entire section at the front of the grocery store is all energy drinks now. So there's something going on with this. There's no doubt about it. They're not all the same, in my opinion. I actually like the taste of Celsius. Not that that really matters. I'm only one person. This is anecdotal. But some of them, I get this tingly sensation, It's just kind of weird and makes me jittery. I don't get that with Celsius, and I don't get that with Red Bull. But I certainly get that with Monster. I certainly got that with C4. So to each their own, find your preference, but some of these have got a ton load of sugar. Some of these have got a ton of caffeine. There's different variations. They're not all exactly the same formulation.
And I think it's a really interesting company. It's actually been around for 20 years. It was founded in the year 2004. So it's about 20 years already. And I think the growth was phenomenal in terms of the revenue growth. We're hitting triple digits. I think the highest revenue growth percentage was 195%. The massive argument now is that we've seen a huge decrease in terms of the revenue growth. The question now I have is the whole industry. Is it affected by seasonality, or is it affected by the business cycle of the particular company? So I want to get your thoughts on that, because to evaluate whether the whole industry, we're talking about Monster Beverage, we're talking about Celsius, they also have to experience the same headwinds. So how do you see the whole entire industry?
Well, let's dig in first to figure out why this industry even exists, right? We can chat a little bit about the seasonality, but I think it is interesting to just kind of see, how did energy drinks even come to be? It actually kind of started with this company called Hanson's Natural back in 1935. This was a fruit juice company in California that was trying to get people to drink fruit juices. Just didn't have any distribution. It was serving this small little niche, but it was well established, right? It had been run for about 5 decades. And then it basically goes bankrupt in 1988. Company completely reorganizes. 2 years later in 1990, it gets reorganized and goes through an IPO. And it says, we're not doing so well with fruit juices. Let's try to start selling natural mineral waters that have flavors that are natural flavorings, right? We're going to pivot a little bit because we weren't doing so good with the fruit juices. And they had limited success with that too, right? By the year 1992, a couple of years later, $17 million in sales. That's not a huge number for companies that are following these kinds of businesses. But then it gets bought by the South African lawyer named Rodney Sachs, who says, you know what? I think that there's something else. We've got to do something completely different. So let's create an energy drink. Let's create something that's got a very high caffeine concentration. Let's go out there and target people that might be interested in this new highly caffeinated energy drink. We know the Coca-Cola's done really well, but let's do something that's a little bit different than what they were. Let's put 160 milligrams of caffeine in this. Let's call this Hanson's Energy Drink. And so this is where they just completely get a hit, Kelvin. It doesn't take me to tell anybody listening to this show how well Monster Beverage, which they renamed the brand to after a couple of years, has certainly done. And then, it gets to the point that in the year 2014, Coca-Cola comes in and says, you know what? They beat us in this category. And so they invest $2.15 billion to buy a sixth of Monster Energy to give them global distribution. And this is what truly propels the energy drink business. Kelvin, Monster Energy, if you got in the IPO of Hanson's back in 1990 when they reorganized into the IPO, 200,000% return over the last 34 years. It's the best performing stock in the entire S&P 500. Is an energy drink company that created a new market, right? That's how the energy drink market came to be. And similarly, Celsius was actually having a lot of trouble in its early days, right? This is a company that's in South Florida. It's appealing to gyms and athletic enthusiasts. They have a drink that they are marketing as being thermogenic, which means that it's going to improve your metabolism so you'll burn more calories during your workout than you would have if you didn't have the drink itself. And so they're kind of going out there and they're marketing this as being the world's first negative calorie drink, right? If it's burning 140 calories, the drink itself only has 10 calories. You're losing weight when you're working out if you're drinking this drink. And so it catches on in Southern Florida. You're buying it directly from the gyms. You're buying it from GNCs, specialty retailers, stuff like this. But nothing really, really big. And meanwhile, Pepsi is watching its number one competitor, Coca-Cola, knocking it out of the park with Monster, putting $2 billion to work in 2014. And by the year 2022, it decides we need to follow in Coke's footsteps. We either need to make Mountain Dew competing directly against Monster, which it wasn't succeeding with that, or we need to build our own formulation, which they weren't, or we need to go out and we need to invest in a partner. And they chose door number 3 on that when they went out and they invested $550 million, 8.5% stake of Celsius in 2022, and granted them global distribution. This completely changed the game for Celsius. I wouldn't have invested in Celsius before this partnership with Pepsi. But now that you've got the distribution taken care of, you've gotten the shelf space in all the retailers. I mean, Pepsi is now 60% of this business, and it's doing fantastically well, Kevin. If you wanted to, we can dig a little bit more into the fundamentals. I know you were talking about kind of the seasonality and how the sales growth, but really bottom line, it was Coca-Cola and Monster that Celsius owns a lot of its own success to, just because they kind of created the energy drink market with Monster Energy.
Yeah, that's really interesting. And I think I agree with the Pepsi value proposition. I think it became a really popular stock because Pepsi has a stake in it. We talked about skin in the game. Skin in the game is very important. I don't think I would have invested in Celsius earlier last year without having the knowledge of Pepsi owning a stake. Full disclosure, I do not hold Celsius to date. I made a profit on Celsius. I sold the stock around $88, went back in around 50, and then the sales data from Nielsen saying that sales are declining. So I decided to take that opportunity to invest the capital into something else. I'm glad I did, because if not, I would have lost another 30-40% from the $50 range, $60 range. So I would consider myself lucky with the macro factors that are involved. And obviously discretionary consumer beverage hasn't been doing so well. And I did my research going to the grocery stores to see whether Celsius is still selling out. And I saw that it's fully stacked. No one's buying energy drinks. Not sure if it's seasonal, but just to take some risk off the table, I decided to sell my position. So maybe you have a different view. I want to get your thoughts on that and whether you see a bullish cycle ahead.
It's good points, and I'm not going to disagree with any of those. That I think there is a little bit of a slowdown, not just with Celsius, not just with energy drinks, but with drinks. All of this is consumer discretionary, and we know that interest rates have been high, inflation has been high, there's less money in people's pockets. So what do you cut back on? You don't cut back on your internet bill. You cut back on going out for a coffee or for getting energy drinks or things like that are superly discretionary. Two things I want to look at here, Kelvin. And by the way, we'll talk about valuation in a minute because a lot of this is already baked into the stock. But when Pepsi made the deal with Celsius, they saw in 2021, the energy drink market as a whole, not just with Celsius, but as a whole, was growing 13% per year. That is amazing. That was 7 times faster than beverages as a whole, including bottled water and Pepsi and, everything else. So Pepsi had to make a deal to catch this red hot market that's out there. And that's not even taking share from one another. That's just people that are buying energy drinks that weren't buying them before. Maybe they used to go to Starbucks and they got tired of paying $20 for a soy latte or so, whatever it was, is super customized. Maybe a $2 energy drink is more of a budget conscious decision. But the energy drink market for the last 4 years has more than doubled the regular beverage industry's growth in the United States, right? 2% regular beverages, 2021, 13% for energy drinks. And now that's slowed a little bit. Right? 2022, beverages overall down 4%, energy drinks up 5%. 2023, beverages overall down 3%, energy drinks up 8%. And then last 12 months, 2024, beverages as a whole down 3%, energy drinks as a whole up 3%. So there's a shift to this market is still growing. None of those has been negative like the overall beverage market has, but the growth is not 13% anymore. It was 3% last year. People are cutting back, but it's still taking share from other beverages they might choose instead. Now let's look within that energy drink market itself, right? About $20 billion in America, $18.5 billion total. And we've got a clear leader at the very top of it. Do you know which one is the leader, Kelvin? It's not Celsius. Do you know who the best-selling in America energy drink provider is? Or would you like to guess?
Monster Beverage.
That's number 2, 28% share for Monster, but there is one that's even on top of that. It gives you wings. Red Bull is the market leader, yes. Number 1, 37% share year to date in the first 6 months of 2024. And then Celsius had about 11% share. But what's really interesting within this is if you look back at 2023, so the end of year last year, Celsius had a 7% share. First 6 months of 2024, 11% share. And then we just got some numbers from Amazon where it's selling directly to consumers. Not stocking it on grocery stores, and shelf space and other things like that consideration, but directly to consumers where the brand is resonating the strongest. 21% share of Amazon sales during the month of July in the ready-to-drink energy drink market. There is clearly a favor within the market for energy drinks to displace the players like C4, Rockstar, Bang, these other ones that have very small market share in preference for Red Bull, in preference for Monster, in preference for Celsius. And so you kind of combine the two of those. You've got energy drinks as a whole growing, whereas beverages are declining. And then within energy drinks, Celsius is gaining share. Those are good dynamics you like to see, especially for consumer facing retail stock like this is.
When I analyze Celsius, I think that one of the difficult things that I compare or look at is what are the alternatives to Celsius? It can be very broad. You could be comparing to Starbucks. You could be comparing to all the coffee chains out there, especially if you're just looking for that dopamine hit to get you through the day. So if you're comparing to that separate industry, the caffeine industry, the coffee industry, then it becomes very competitive. But then if you're comparing to maybe Monster Beverage, I think it becomes a bit more attractive because I do think that Celsius is a better product than Monster Beverage and arguably Red Bull. I think there's that debate whether you're comparing Celsius and how it performs in the global market of the caffeine industry or the coffee industry, or are you just comparing to the players within the energy drinks business? How do you see it, Simon?
I think if you've been drinking coffee your whole life, you're probably still going to drink coffee and you're not going to go to an energy drink, right? It's just a different product. At the end of the day, it's caffeine, but you're not going to drink something that's super sweet if you've been just drinking black coffee for the last 30 or 40 years of your life. But Celsius says its prime demographic that it really wants to target is 18 to 24-year-olds. Not minors, not teenagers, for the same reason that coffee hasn't aggressively gone after teenagers, but kind of that young generation, that is really kind of not as excited about Starbucks as maybe we were years ago, and might be interested in energy drinks, especially if they're athletic, they want to go work out or things like that. I mean, the slogan is live fit, right? It's not you need caffeine to function at work at 8 a.m. It's, you want to kind of have this lifestyle brand that they're building and selling one or two to people throughout the day. I do think that it's interesting you bring up Starbucks. Starbucks I used to really love as an investment that I've gotten a little bit more cautious of here recently. They reported a 6% decline in transactions in North America this last quarter, which is a problem. If people are not going into the stores, it doesn't matter what they're pricing their coffee. They're just not going to get those sales anymore. Starbucks is having a lot of problems in China right now with the price war, with Cody Coffee, with Luckin Coffee. There's a lot of price sensitivity over there that Starbucks doesn't really know how it wants to react to. But it's certainly affecting both Starbucks and Luckin just in the price war that we're seeing in Asia Pacific region. And so this is not just a Celsius specific issue. I think that a lot of beverage stocks right now are kind of figuring out, okay, we've got a price conscious consumer. This is a discretionary spend. And we've got some players that are very, very price aggressive, especially in the coffee industry. When things like this are moving quickly, it's hard to do all things all at the same time. I think Starbucks really needs to fix, they've got a new CEO that just came in. Starbucks has got a new CEO that comes in. He comes in from Chipotle, and he's going to really focus on, I think, Asia and the core American consumer. But I still think that the energy drink market has got a much more beneficial tailwind behind it that Starbucks wishes that it had right now, that it just doesn't. It's got to fight a lot of fires in the meantime.
Starbucks have a lot of internal issues that they have to face, which is probably very different to what Celsius has to face. I think in terms of differentiated services and products, I would say that Starbucks would have a bit more in terms of flavors, in terms of the services that they provide, whereas Celsius is a bit more clear cut in terms of they're just providing energy drinks sold in retail stores, grocery chains. But also on top of that, it's the brand partnerships that they're doing that's quite exciting. Recently, they've worked with Ferrari from F1. They're also expanding to Australia and France and New Zealand. So those will definitely help in terms of international sales. But I do want to go back a bit because we talked about Pepsi as a big component to sort of the investment thesis into why people would want to invest in a company like Celsius. But would you argue that Celsius' future is quite dependent on Pepsi's view or stake in the company? How do you see Pepsi's involvement here?
I think it's hugely important, actually. I don't think that if you're trying to form a national brand, much less an international brand without distribution, you're not getting anywhere. You can fight this battle uphill forever, but still retail grocers, they've got so much shelf space. They've committed so much of that to Pepsi already. You're going to be spending a lot of money on sales and marketing if you're going to try to displace it on your own. It's almost impossible. You have to have distribution. It's the same thing that Monster did when they did their deal with Coke, right? And so I think that, the big risk is what's in it for Pepsi in this. If Pepsi pulls this exclusive distribution agreement with Celsius, what's left? I think that that would be a really big risk for the investors in the company, that if they ever did pull the deal, then you've got to fight that uphill battle on your own. You don't want to. But on the other hand, I think Pepsi's getting a pretty good deal on this too, right? Pepsi doesn't want to abandon the energy drink market. If it does kind of, sabotage its partnership that it has with Celsius, is it going to sign one with somebody else who just saw them do that? Probably not. It's got preferred shares, so it's getting a dividend no matter how well the business does. And then it's also got the ownership stake, right? 8.5% ownership stake. So it wants to see Celsius succeed. And it certainly has in recent years. Now, the question is kind of, how big can this be internationally? We're starting to see Pepsi open doors within the United States at new places that Celsius wasn't before. Jersey Mike's, right? Dunkin' Donuts, these kind of quick serve restaurants is something that Celsius wasn't even selling to before, and now it has access to. And it's also opened door to some of these club stores that Celsius used to sell to before, and then lost those customers, and then regained them now that Pepsi's on board again. Specifically Costco, which is a huge buyer. You can buy Celsius by 12-pack or 18-pack at Costco's now. Internationally is not quite as proven. We've got now the UK on board. We've got France on board. We've got Canada on board. We've got Australia on board. This is more of a competition, I think, against Gatorade and sports drinks than it is so much against coffee, which is a little bit more established in those regions. But it's going to be interesting to see how it does. I mean, Monster and Red Bull are already doing business in each one of those locations, but it's less than $1 billion in each one of those markets compared to the numbers in the US, which are $7 or $5.5 billion for those companies. So they're still early, but it's not to say it's not going to work. I mean, this is something that Red Bull was previously illegal in France, right? They banned energy drinks because they had too high of caffeine content. Now they've opened the doors for them to sell again. Red Bull is owned by a German company, that's first distributed in Austria versus the United States. And it'll be interesting to see how this plays out. I do think there's potential, but I don't want to set the scene that international sales are just going to completely knock it out of the water. They were $20 million in the most recent second quarter for Celsius. That was up 30% year over year. That's great, but still only 5% of total revenue. It's going to take a little bit of work to penetrate those markets and a lot of marketing.
Fundamentally, it's a profitable business, no debt, lots of exciting partnerships ahead. As I said, it's a very easy business to understand. And at the same time, with all the uncertainty with discretionary staple and the whole entire industry, I think that there could be more risk ahead. I want to get your thoughts on Celsius management recently disclosed a significant inventory reduction by Pepsi, which amounts to 100 to 120 million USD. I don't know if you see this as a temporary thing, or could there be more warning signs ahead? What are your thoughts on that?
It's a double-edged sword, right? When you're working with Pepsi, it's not just going to go up all the time. You've got to take the good news and the bad news. The really good news was that at the end of 2022, 4Q 2022, when they signed a partnership, sales doubled within the next 6 months. Quarterly sales literally went from about $150 million a quarter to more than $340 million of sales in a quarter. Because Pepsi stocks up, right? If it's got the shelf space and it's excited for this market that it just saw it grow 12% at the top line, it doesn't want to run out of product. It wants to make sure it's got plenty on hand. And remember that a Celsius sale is completed when it gets to Pepsi's trucks. Pepsi then gets the ownership in the inventory, and then it's up to Pepsi to set the pricing and the shelf space and everything with the retail establishments that it serves, right? So Celsius got a huge pop in 2023 when it just sold a ton of product to Pepsi, was willing to hold on to it. And then when that growth slowed, we saw it go from 12% top line growth to 5% and then to 8% and then to 3%. That's the overall energy drink market. I mean, yeah, Pepsi probably overstocked a little bit, and now it's coming back and saying, hey, we're going to do a destock, an inventory destock of $100 to $120 million. Some people are really freaking out over this, Kelvin. I am not freaking out over this, right? When you grow your sales, your quarterly sales by $150 million basically overnight, and then you come back and you say, hey, guess what? We overstocked a little bit. We're going to have to destock $120 million of that. I'm not super worried about that. $400 million, 60% of which it went to Pepsi. And by the way, now they're bringing it to Canada and to France and to the UK and Australia.
When you look into Celsius, the financial metrics, what do you look at in particular? For me, I do look at inventory turn, revenue, sales, margins, and so on and so forth. But I do think that inventory turnover is a bit difficult to analyze whether the company is doing well because it could go up and down like a roller coaster. Like, for example, if I pull up some numbers, I think in Q2 24, we see an uptake in the inventory turnover. And then Q3 2023, it was going down. And then like recently, the last quarter, it went back up. What kind of metrics do you care about or not so care about?
There's a lot of ways we could look at this, right? And as investors, I think even sometimes we make things harder than we really need to for ourselves. I think that probably for me, it's gross margin dollars expanding is probably the number one and most important thing, right? Are we making more money? Now, you don't want to just completely give up pricing where you're selling everything basically for a penny to Pepsi and then they take it from there. But as long as you got margins that are kind of stabilizing or, very, very favorable, I think it's, what was it, 52% gross margin or somewhere around there. I mean, that's very good. That's a very profitable business. And then in terms of overall sales growth for Celsius in US 2024, gross growth in dollar terms of $425 million. I mean, it's working, right? Pepsi is working. They're making it work for them. It's working out for Celsius. I think that's the first thing. And then the second thing, like bigger picture, what did Monster do right? What did Monster do so well where everyone else failed? I don't want to see triple digit growth for Celsius. As crazy as that sounds, you want to go out there and grow super fast, but I don't. I would rather see Celsius in these international markets be the dominant market share, or at least grow in a really, really quick market share presence in Australia and in the UK or in France where there's got competitors, right? I don't need it to see 200% growth. It almost feels like it's growing too fast if that's the case. I would rather see that it's resonating with consumers and they're really demanding the product and it's winning against its competitors. And by the way, it's really taking care of all the places that it's selling it, right? Because it's a risk. If you're a store, if you're a convenience store, you've only got a limited shelf space and nobody knows what Celsius is. You want to make sure that like it's working out if you dedicate some time to putting this new product on your shelves. And so you're not going to go out there just day one, everyone's just suddenly going to stop buying whatever it was they were buying before and just buy Celsius. But if you just kind of operationally take care of your retail partners, make sure you've got product available when they need it. Make sure you understand kind of what you're displacing if they're selling something else instead. That's the key to international growth. Slow and methodical and let that take care of itself over time. These are billion-dollar markets, Kelvin. This isn't like something to sneeze at. There's a lot of money on the table, but let's not blow holes in the strategy by trying to grow too quickly.
We talked about investing sometimes is like trying to run a company. It's hard to not think like that. Like when I invest in a company, I often think, how should management run this company? Or if I were to invest in this company, what would I prioritize? So I flip that question to you, Simon. If you were to run Celsius, what would you prioritize as the CEO of the company?
I mean, if you want to be a lifestyle brand, so much of this is marketing, right? Just being top of mind, right? And I think that Celsius doesn't want to get into this fight with Monster and Red Bull about who's got higher share. They're glad to claim victory when they're selling better than they are, but it's not like you want to completely piss off your largest competitors when they're there too and they're established. I think that more so, John Fieldly needs to go after new people that haven't been buying energy drinks before that might consider this now. And I think one of the biggest things that you've got if you're an energy drink is that it's ready, available whenever you're ready. It's just like ready and then boom, I pop open a Celsius and it's ready for me at the workday, right? I don't have to go wait in the Starbucks line for 20 minutes because, there's 20 cars in front of me that I have to sit around and kill my lunch break to get a Starbucks coffee. It's like, boom, I've got a Celsius that's right there in the fridge. It's ready to go. And by the way, it only cost me $2 instead of 6 or 7. That's the play I would be going after is marketing for business people. And then for the younger generation, they're still going to be out there wanting to work out, live fit, live athletic, have Celsius. You can appeal to that through commercials and podcasts and, the right demographic channels. But I think that so much of this is marketing, being top of mind and making sure that when people are going to the grocery store, that's what they're buying. And then, the other thing is Fieldly is an accountant by trade. He's a CPA. He came in actually to kind of correct the ship, which was sinking quickly before this partnership with Pepsi got in place. He's done a really good job with working capital. He gets a lot of credit for this Pepsi partnership, but I do think that he's uniquely qualified to make sure that a lot of these kind of things like inventory stocking and making sure that the operational side of the business is checked. The trains are leaving on time, so to speak. It's more of the trucks are leaving on time specifically, but a lot of that really does come into play when you're dealing with kind of retail.
Many good points there. Do you think differentiation is a concern for a company like Celsius? A lot of retail investors or in investor community boards, they often debate whether Celsius lacks differentiation. Like, for example, Monster Beverage has a lot of different segments, right? They're tapping into the alcohol segment as an example. Do you think that in order for Celsius to be competitive in the beverage space, they need to differentiate their products, or should they just stick with selling cans of energy drinks in different flavors with continue to promote its benefits to health? When I read their earnings presentation, a lot of it is backed up by positive scientific studies that they continue to promote. So what are your thoughts on the differentiation concerns?
I think that was important at the beginning, but it's not as important now that it's getting a foothold, right? You had to differentiate at the beginning when they needed Pepsi to partner with them. Like, why partner with Celsius versus the other 10 that had a market share in North America? And so Celsius kind of got its name with that athletic brand that Pepsi wanted to bring in to be a lifestyle brand. Depending on how you interpret that question, you don't want to be too crazy and off the wall out there, right? You don't need to have caramel popcorn flavored energy drinks just for the sake of being different. It's like people are going to come back to strawberry, and lemon lime and the same flavors that they want to drink and get used to. I think that probably the big differentiator is how many carbs you have and how much sugar do you have, right? I think that's something that, Monster, when people look at 54 grams of sugar in a Monster or 58 grams of carbohydrates, and then they look at the same thing in Celsius, which has got 2 carbs and 0 grams of sugar because it's an artificial sweetener. I mean, things like that probably are the bigger differentiator rather than flavors or different, trying to do things totally different anymore. Pepsi wants what's going to sell. And so now this is more of what is most mass market appealing in retail.
We talked about competitors. We talked about Monster Beverage. Who do you think is Celsius real or true competitors that they really have to compete with?
I think in the US, is the shelf space is just basically what grocers are going to stock the shelves with because it's selling the best. So I do still think that Red Bull and Monster are the top 2 competitors, because if you only got so much shelf space, what's selling? What do you want to buy more of? That, in my opinion, is the easy answer, but it's still the energy drinks. But then, the interesting piece is, how is Celsius growing 23% year over year this most recent quarter when Starbucks is losing 6% traffic through its stores, right? Is there a correlation to that? I think so. I think that, that is kind of the bigger picture of what's going on. Coffee, what was it, $110 billion that Americans spend on coffee last year? When you consider Starbucks sales and then also, the made at home sales, I mean, that's a huge market. That's 5 times, almost 6 times bigger than the energy drink market was last year. And so if there's true growth, maybe let's not just keep fighting it out with Monster, with Red Bull about who's got shelf space, but what's resonating with consumers and where are they getting their caffeine fix?
To have a follow-up question on that, do you think the energy drinks industry is difficult to disrupt?
Yeah, for the same reason that Domino's is difficult to disrupt, right? Sometimes we go chasing the most sexy thing that's out there, whether it's generative AI or whether it's immuno-oncology drugs or whatever else it is. But it's like, at the end of the day, sales are sales and cash flows are cash flows. And like you mentioned earlier on this interview, this is a very simple business. It's just all about execution, right? We don't need to make it harder than that. It's Celsius producing cash flows that are attractive as an investment opportunity. I don't think it's disruptible. I don't think that AI disrupts energy drinks.
I'd argue that Celsius is not an easy stock to hold. I think we talked about this. The average retail investor holds a stock for 5.5 months. I think it's absurd that people hold or invest in companies for just 5.5 months and fail to see the trajectory for the next 2 to 3 years. I think Celsius is definitely on my watch list. It's whether seasonality does play a factor. And obviously there's huge drawdowns with an entire industry. We can look into the numbers, but Monster Beverage is affected by the declining sales. So it's not just Celsius. We invited founder and CEO of Seven Investing, Simon Erickson, to share with us what Seven Investing is all about, as well as his knowledge on investing in innovative companies. So we partnered up with Seven Investing, which you can support my podcast, Me and the Market Goliath, today by signing up to Seven Investing's annual newsletter subscription. By signing up, you will receive their recommended stock picks per month, research reports, video deep dives from their lead advisors, and monthly subscriber calls, including all of their previous stock picks and exclusive access to their members-only community forums. You can use promo code Goliath to enjoy their annual membership subscription for just $170. So maximize your market intelligence with 7 Investing's newsletter service and lead advisor insights today. Me and the Market Goliath will also be giving away 25 USD Amazon e-gift cards if you subscribe to 7 Investing's yearly subscription service using our promo code Goliath. For a limited time only, and terms and conditions apply. Please refer to the show notes for more information. Now back to the episode. Why is Celsius a stock that looks great on paper, but contains so many red flags that maybe an average retail investor probably wouldn't be able to see?
Nailed it, Kelvin. My goodness. Part 2 of the conversation. Let's jump right in, right? From being super bullish on Celsius a month and a half ago to really changing my mind. And now I've kind of changed my opinion and I would recommend getting away from the stock. I just sold all of my personal holdings. And what you said nailed it. I mean, this is something that you look, the first layer, the second layer looks great. The earnings look great. The fundamentals look great. The investor presentations, the annual reports, it all looks great. But then as a long-term investor, as somebody who wants to hold a stock for 3 years or longer, every time I buy something, I started noticing some real problematic red flags. And I think it's responsible and really the right thing for us to do to come back and do a part 2 for this podcast, being that it was just a week ago, Kelvin, that you and I were talking about how excited we were about Celsius. Things have changed since then. I got an update that was really important and it really caused me to question a lot of things. And so I'm really thankful for you having me back in the show again for a second part of this conversation.
Can you tell me more in terms of what are the reasons for you to change your mind? Celsius is a stock that literally took you for a roller coaster ride. And it's probably a good recipe to avoid similar stocks like this. So it's important to go in detail in terms of what are some of the red flags. I've read your articles and they're really in depth and each of the reasons make sense. Can you take us through your thought process?
One of the keys to investing in this in the first place, the bull thesis, was the partnership that it had with Pepsi. Celsius started, as we talked at length, in Southern Florida selling to gyms, didn't have any kind of national distribution footprint. But in 2022, it got Pepsi, one of the largest distributors of bottled beverages, to have a distribution partnership that all of a sudden opens all these doors into grocery stores, into convenience stores, and all the stuff that Celsius never had before. It immediately vaults it into profitability. And so when we're looking at this in mid-August, when I was super bullish, I saw, yes, Pepsi is introducing it into Canada, into France, into Australia. It seems like everything is going great. And we're seeing sales growing at 7 times the energy drink average. All of this seems like it's really good news and Pepsi is really on board. And this is good for Celsius's shareholders. Then there was the Barclays conference on September the 4th. And this really just kind of surprises everybody when Celsius for the first time announces that for the upcoming quarter, Pepsi is going to cut its orders in half. It's calling it an inventory destocking. It bought more product than it needed. And there's not a whole lot of context into why that happened. But we can kind of figure out, Kelvin, it's one of 2 things. One, Pepsi purposely overbought product from Celsius because it wanted to have plenty of inventory available for retail, right? It didn't want to run out. It wanted to make sure that the shelves were stocked. And it did this to itself. And this is just a natural destocking. But the magnitude of it, $120 million of destocking in a quarter, suggests that Pepsi really got it wrong, right? That's a lot of inventory to hold if you're not selling, especially for a company who's so mature and has this figured out and really good relationships and visibility into the retailers that it works with. So the other possibility, which I found myself more and more considering, is that Pepsi expected Celsius to sell a lot better than it ended up doing at the retailers, at the end user channel. And this destocking is not just, oh, hey, we purposely overbought and everything's good here, but we didn't get out of this what we were expecting to get out of this. That to me is a yellow, maybe even orange, borderline red flag that one, Celsius has not got that kind of visibility into Pepsi's orders that it's seeing in the retail channels, or it's not sharing it with them, or they just stayed quiet about it. Or more concerning is that Celsius, even though it goes out there and talks about how great its market share gains have been, maybe that's in the rearview mirror and looking forward, that's just not how things are going to be going forward. So the first and greatest red flag was Pepsi's erratic order patterns with Celsius, which have caused the growth rates to decline and are going to further decline here coming up in the second half of 2024. Number one red flag.
It was really interesting because I read through the article that you recently posted, and it seems like Celsius management team didn't even see this destock coming because they pointed out that during Celsius' second quarter conference call on August 6th, the CFO publicly stated that the impact of the inventory management during the middle of June was approximately 20 million to 30 million. So they didn't see this coming at all. And, forecasting is always art. It's always difficult to forecast these things when it comes to how much inventory your clients are going to take hold. And I think that was something that we brought up. Part one of the podcast episode was the inventory turnover. It's difficult to predict. It's like a roller coaster. So that's a really great observation that you pointed out. You mentioned that it's a double-edged sword. Like right off the bat, you said that it was a double-edged sword and it could either benefit Celsius or it could ruin Celsius completely if Pepsi does something with the contractual agreement or the stakeholder ownership.
I'll click on that just a bit, Kelvin. Would you mind if I expand a
Yeah,
little bit more on that? Yeah, it's a great
absolutely.
point too about the agreement, right? Because these are preferred shares. These are not common shares like we're buying of Celsius. Pepsi is getting a dividend for preferred shares, put $550 million to work. It's a good 8.5% ownership stake in the business, and it's getting those dividends. So it seems like it's beneficial to Pepsi. But I also think we shouldn't just ignore the fact that there's no penalty for Pepsi breaking this agreement with Celsius. It's in good faith that it's going to be a distributor of its product and it's going to give it shelf space and all these other rainbows and butterflies. But Pepsi also has Rockstar, right? Pepsi bought Rockstar, acquired Rockstar, which is an energy drink that competes against Celsius for shelf space. If Rockstar starts selling better than Celsius, would Pepsi want to sell Celsius that it's having to buy from them and give gross margin dollars to just to put on the shelves next to a wholly owned acquisition that it hopes would sell even better and make even more money from? Maybe not, right? Pepsi's also got Mountain Dew and its own kind of carbonated energy drinks. Those are a little bit different. They've got the caffeine, but it's a little bit different with Mountain Dew versus a Celsius. But it's not like Pepsi hasn't tried this before. And even though it's working for them in the last 2 years in this partnership with Celsius, they're both making a lot of money. I think that if Celsius is not selling on the shelves, and again, we go through door number 2 of why Pepsi is destocking, I don't think there's anything holding them back. And if that's the case, what is Celsius left with without its prime distributor that now is saying, hey, we want to distribute Rockstar. We want to do this on different terms. We're going to break this agreement. I think that is a significant capital impairment for investors in Celsius if Pepsi pulls the rug out from under them for
Mm,
any reason.
yeah, those are great points. Also, I wanted to add, because I think you mentioned that the drink formulation is a trade secret that isn't protected by any patents or intellectual property. Could you elaborate more on that? Because I think that does play a huge role, whether Pepsi is going to switch, right? If Celsius doesn't really have an IP and competitors can just copy their formulas and ingredients, then what is Celsius' competitive edge? So I was hoping that you could elaborate on that. I think that's a very interesting angle to look at the energy drink space too.
It's all branding, Kelvin. This is not the biotech world where you have to go out and get a patent and get FDA approved, and you got protections for 20 years to sell that molecule commercially, right? We're going to keep it secret how we're making our energy drinks. People are going to get close, right? There's white label Coca-Cola hasn't revealed its formulation. People have gotten really, really close. But just the brand that people are buying Coke want to keep buying Coke. Same thing with Celsius. But there's really nothing secret about what's going on here. They tried initially to differentiate by saying that it boosts your metabolism. It's got thermogenic effects that if you drink these, you're burning a lot more calories during your workout than you would if you were just working out again or by itself. Again, that's a far claim to say it's boosting your metabolism versus it's just increasing your heart rate and your blood pressure from having caffeine in it. Those are two very different statements. The FDA has not approved anything like that. So there's no protections on the formulation. It's just Celsius saying, hey, we've got a brand. If you believe us or you like the taste of it or you want to keep buying Celsius, go for it. But there's really nothing protecting others from doing exactly as close as possible of a label as what Celsius has. If you go out and they put out kiwi guava as a newest flavor and they're really excited about it, and then all of a sudden Monster or Red Bull does the exact same thing, there's nothing to stop competitors from doing something like that. So it's really hard to differentiate in this space, considering also the consumer retail is fickle and our tastes change. It wasn't that long ago that Jolt Cola was a huge deal because it had tons of caffeine. It was giving you that pep that Coca-Cola wasn't. But I haven't seen Jolt Cola really having the same brand that it had 20 years ago. Same thing could happen with Celsius. As a long-term investor, I don't see any protections or even tangible assets really that are protecting investors if things change.
So another point of your bear thesis on Celsius is the management team. When we look at a stock or a company, we often look at management. Why do you think Celsius management team is overlooked by so many average investor out there? I think primarily retail investors, especially if you look into the X community, people are saying that Celsius is a great valued stock to own, given that it's losing a lot of its market value over the past couple of months. Why was the management team overlooked here?
I think that's the right word to say it is overlooked or not being appreciated enough. I think that if Kramer comes out and points out the 7 red flags that I pointed out in my sell recommendation, this stock sells off by 50% because these are some pretty glaring things in my opinion. The key problems with management is the first and foremost has been really heavy insider selling. The early funding for Celsius and still about a quarter of the business is owned by Carl DeSantis's family. Carl DeSantis was a billionaire entrepreneur. This is a guy that was looking for kind of nutritional supplements and healthy vitamins and things like this. He really liked what Celsius was doing in the early days, 20 years ago, and buys enough of the company that even today, he's got about a 24% ownership stake, at least as of last summer. Last August, Carl DeSantis passes away, unfortunately, leaves his fortune to his family, who are very minimally involved in the business at all. No operational influence whatsoever. You do have one of his sons that's sitting on the board of directors, but really we don't know what their intentions are for a quarter of this business, right? They could sell it to private equity. They could put it up for sale for Pepsi. We don't know. We don't know what's going to happen with about 25% ownership and control of Celsius. We do know that they've been selling a lot of shares. The ownership of the family has been consistently selling since last summer. And we do know that following them into those sales since last summer has been the executive management team, right? The operational people that are actually running this business, which is curious to me. Why would John Fieldly, the CEO who rescues this company out of bankruptcy back in 2012 and has been basically overseeing the stock crushing the broader market, why is he not buying shares? Why would he not be accumulating shares knowing that Celsius has been on such a tear? He's been exclusively selling along with 6 other executive leadership people that are mentioned on their leadership team. All of them have not bought a single share since DeSantis' death last August. Only selling, and it's been to the tune overall of 771,000 shares that have totaled $64 million. Fieldly has accounted for 2/3 of those sales. That's like a big red flag for a long-term investor. Why do you not have the operational leaders of this company buying alongside you? Why are they all cashing out when we're supposed to be buying shares of this business? Coupled with the Pepsi, the slowing sales and the uneasiness that I have about the Pepsi relationship, along with the owners of the business selling and then the managers of the business basically owning none of this business and cashing out so much, those are big red flags. And then even culturally, Kelvin, I know that after you had seen the sell recommendation, you had done some great deep dive research into the company too. I guess it was Glassdoor. I don't know where you had found the reviews, but it seems like a really toxic sales culture too, which is certainly a problem for a consumer facing brand like this.
Yeah, I think that was very interesting. Even though, full disclosure, I do not own any Celsius stock, it's always worth looking into a company's culture, like whether it's going into the Glassdoor website, looking at employee reviews. I think that gives a good snapshot, actually, in terms of how are the managers behaving, and also are they underpaying or overpaying their employees. It should be the primary investment thesis, but I understand that there's always going to be a conflict between the employers and the employees' mindset. When I went to Celsius Glassdoor reviews, I think there were some glaring red flags with their chief commercial officer. I don't know, Simon, if you want to go into that, but it's a very interesting discussion because it seems like this person is never there, but for some reason, he still gets bad reviews from former employees with regards to the company direction, with how employees are treated. So What are your thoughts on that?
It's a sensitive one, Kelvin. It's really hard to lob Molotov cocktails at companies for bad HR problems because every company has got HR problems, right? It's always hard, and I'm not trying to disrespect that in any way. And certainly that goes all the way up the ladder, right? It's hard to criticize CEOs of companies that are running multi-billion-dollar companies or even chief commercial officers. Just objectively, in the analysis that I found, Tony Guilfoyle, their chief commercial officer, has basically zero digital presence and never posts anything. Doesn't seem like he's attending any conferences, is getting excessive compensation, automatically sells all of his stock that he gets, automatically sells all of his options that he's getting, and has got on top of that really a resume that he's listed previous positions that there's no Google record of him even doing those things. The Glassdoor comments, you had mentioned that kind of some of the sales team that works for him saying he's got to go and this is a toxic culture, not to mention even come at some of the family ties that are very heavily skewed towards one political party, which could be a risk when you're selling to all of America, which is pretty much divided on their political opinion. Again, it's sensitive. You don't want to go out there and criticize anybody personally, but for me as an investor that it's going to be a long-term shareholder in a company like this, these are the people at the top that are steering the ship, right? You want to have confidence in what they're doing. And I don't have a whole lot of confidence in their executive leadership credibility.
Is there a clear winner in the energy drinks industry? Do you see a clear winner?
Right now, there is a clear winner. It's Red Bull, who's got 27% market share, and that's significantly higher than Monster at number 2, and then Celsius at number 3. And then after that, there's really everyone else is fighting out for 5% share, right? Everyone else is very small. 3 key leaders, like it's got to be those 3. Just the nature of consumer purchases and the nature of brands and consumer retail works. Pending anything just completely blowing up, I would be surprised if people that are drinking coffee their whole life all of a sudden just start drinking Celsius. If people that have bought Red Bull and stocked that in their fridge their whole life just all of a sudden say, I'm done with this, I want to use Celsius. So I don't think there is a clear winner. Yeah, I mean, Monster has been trailing Red Bull for a long time, right? And it's still owned by a large German conglomerate. Red Bull is. Monster is bought by a South African lawyer. And now you've got Celsius that's got owners of a kind of nutritional supplement family that are pushing this. You kind of have these powerhouses that push the brand and invest heavily in the marketing. And I think that's what keeps them at the top. And then you get the distribution that makes it hard for anybody else to even get shelf space. That's a competitive advantage that's out there. To answer your question, though, I'm not sure. I don't see a huge opportunity for Celsius to be the leader, but I do think it's possible that they're going to stay within 15-20% share of the American energy drink market. And I still think that Red Bull and Monster probably stay above them.
And if we zoom out to the caffeine space, do you see a clear winner there?
Beverages is interesting. And like we could even couple energy drinks in there too, right? If you're appealing to people that are going to the gym, instead of drinking Gatorade, maybe they're drinking Celsius. So this is a big market, right? I mean, even just energy drinks, ignoring Gatorade and sports drinks is $20 billion in the US. Smaller than that internationally, but still opportunities to kind of grow these markets. I don't know. It's a big opportunity. Caffeine drinks in general and sports drinks in general is big. I mean, Gatorade made a lot of money. Powerade made a lot of money. Starbucks made a lot of money. Consumers want to have energy or caffeine if they're working out or, trying to get through the workday. It's still going to be there. But the question is someone going to do what Starbucks did or what Monster did looking forward? I don't think so. I think that, a lot of what I liked about Celsius was that Monster validated that it was possible to be a fantastic stock in a simple market, right? 200,000% gain over 30 years. And I think I tricked myself into thinking that Celsius was going to be the next one to do that. Even if history rhymes, maybe they're going to follow some of the same footsteps that Monster had followed. But Celsius, with the size that is $8 billion company today, is not going to have a 200,000% return. Is struggling to even gain share in a market that's already pretty well established, where it was just for monsters for the taking when they kind of started this back in the 90s, 30 years ago. It's not apples to apples. It's not going to be Celsius just does what Monster did, and all of a sudden it becomes the next greatest thing in the stock market. Things are different right now that are more of a headwind than it was back. So I think there's growth. I think there is an opportunity. Again, this is a large market, but it's fragmented. And there's a lot of competition, and for various other reasons, consumer tastes are fickle. I think it's going to be a lot harder this time around.
Simon, I can't imagine what you went through the last 20 days. You pretty much rode the Celsius bull, and then you got mauled by the Celsius bear. Besides maybe not drinking another can of Celsius anymore, what were some of the investing takeaways from investing in Celsius?
As somebody who's running an investing service, this was a tough one because you kind of have to go out and say, well, hey, I changed my mind, 180 degrees. Some people said I was pulling the rug out from under others were saying, why didn't you catch these in the first place? And there was some feedback, which is fair. Criticism like that is fair, but it's tough to come out and do something like this. It could have been much easier for me to just say, oh, no, things are fine with Celsius. There's a couple things I don't like, but, we're going to keep it out there. I chose to come out and say, I'm changing my opinion on this. And like I said, I did personally sell all my shares. This isn't something that I'm just doing and it's going into the ethos. I felt strong enough about these that this isn't just a hold or let's see how things shake out. As a long-term investor, I'm really concerned about a lot of these to the point that I ended up saying, I'm out. We're going to see what happens. I don't trust the company and the credibility and the insider sales are concerning and the Pepsi partnership is concerning. This is not something that I wanted to hold on for the next 3 years. I'm going to take my little loss that I had for the last couple of weeks. I think that I feel good about that, Kelvin. I feel good about doing what I feel is the right thing, even though it's kind of challenging to say stuff like that within such a short period of time. But I also want to stress that, these are kind of behavioral biases that we all face as investors. And I've been doing this for 20 years and I still face these behavioral biases to the point that I'm able to come out and say, hey, look, I made a mistake on Celsius. I was really excited about this. I was really excited about the valuation and the growth rates and the partnerships and all this. To be able to pivot and say, hey, some of this gut feel that I don't feel good about isn't going away. And it's be one thing to just shove that down and be like, no, we're going to stick to our guns here versus allowing yourself to escape this echo chamber of being a bull and trying to only look at the positive things that would support. If you buy the stock, you sometimes we just look for good things. We just look for positive news articles. We want to tune out the stuff that disagrees with what we thought, especially if we buy the stock, right? It's so easy to just say, oh, I'm just going to ride with this, yeah, of course, there's two sides to every trade, but I bought the stock. I'm a bull now. I allowed myself to overcome some of those behavioral biases with Celsius and escape this echo chamber of good news and actually recognize, yeah, these are probably some red flags that, I didn't catch in the first and the second wave. But it doesn't mean that they're not there. They don't go away. And by the way, I'm kind of the black sheep, the lone wolf here that's kind of coming out here and criticizing Celsius, being that this is a stock that's sold off 40%. And most people are saying it's a screaming buy and the fundamentals support a buy, not a sell right now. That's kind of challenging. And even I have admitted, Kelvin, that I think the stock probably will recover a little bit here in the short term, just because of all the pessimism that's weighed this year on the share price. It's still maintaining good fundamental growth. I'm not surprised if Celsius gains somewhere between 20 and 50% from where it's selling right now. But for me as an investor, seeing that the opposite was also very true, where just one damning report from somebody like a Kramer, somebody that's very influential for the institutional buyers out there. I like to think that seven investing is influential enough to sway those things, but it certainly doesn't have the distribution that somebody like that would. I really could see this going the opposite way, where if Pepsi says we're out with the partnership, or you see even more insider selling that gets picked up out there, I could very well see Celsius falling another 50%. I didn't want to stick around to see which way those go. So I just said, I'm going to take my loss. I'm out.
Have you heard any counter arguments to your sell reasons, the ones that you've mentioned?
Mostly on valuation and fundamentals. I would say that a lot of the comments that I've gotten, which I've been open to, but a lot of the people that are saying, no, Celsius is a screaming buy. What are you thinking, Simon? You're crazy. Have been focused on the growth rates and the Pepsi partnership and the international growth that's going to happen later this year. The international growth is still unquantified. We don't know how well that's going to go. Celsius could knock it out of the park in Canada, or it could fail miserably in Canada. We don't know how well it's going to sell there. Same with Australia, same with France. So that's still a question mark for a lot. There is no denying the insider selling. That's fact. Those are numbers. When you look at the reports that they have to disclose about management, you can't dispute that. You can interpret that differently. People sell for a variety of reasons, but in my opinion, you can't dispute that the selling is happening. Same with the insider concentration of the ownership. And then also the facts of the distribution agreement with Pepsi, who can cancel at any time without cause. They don't have to have a reason for canceling that. That's part of the agreement itself. And so generally the bull thesis right now has just been like, you look at the historical valuations, it's relatively cheap in terms of price to earnings, price to cash flow. It seems like things are going well. But again, so much of that is just based on these last 2 years with Pepsi. And then all of a sudden we get kind of this super surprise that Pepsi is going to cut its orders in half for this upcoming quarter. Kelvin, if it does that again in the fourth quarter, we got a real problem on our hands.
I agree. I think there's the opportunity cost question mark in play because you probably can take your capital and invest it in something that's fundamentally much more attractive. One more question. After this experience, when you look into your next investment prospect, how would you approach it differently?
This is the beauty of investing, right? It's a marathon, not a sprint, right? 20 years in investing, you still learn more. Warren Buffett said he learned more in his 70s than he did in his previous 70 years as an investor. It's the fun part. It's a lifelong journey. You kind of get to see new things and learn from it, then incorporate that into your process to get better going forward. My takeaway from this one is that we've got to respect the hype cycle. I'm a growth style investor. I want to invest in the future. I don't want to invest in Walmart and Target and things that have already really had their time in the sun and are very stable and very great companies. Don't get me wrong, but that's not the growth. That's not the future of where markets are heading. But we have to respect also that when fundamentals are improving and people get excited about top line revenue growth and maybe even operating margin growth or even cash flow growth, companies are printing those. This is a second or third or fourth layer deep of peeling back the skin of the onion and figuring out what's really going on. Why is Celsius growing as quickly as it is? And we answered that, yeah, we love Pepsi. We love the partnership. It's probably a key part of the bull thesis for this stock. But then you look at it, it's like, okay, what's keeping this from changing? Knowing that sometimes skyscrapers don't just grow on forever. Sometimes you have to respect what is it that caused that growth, and is that likely to continue going forward? And so it's the same thing in cybersecurity or enterprise software. Sometimes partnerships can really make you, but they can also break you, especially when things don't go as well as you were expecting for years in the past. The takeaway is dig deeper into management and what they're doing and what are their plans and kind of what's going to be the next growth rate out there. I love to see addressable market numbers, but that's not confirmed until you see execution. And Celsius had excellent execution. We can't deny that for the last couple of years. But the growth is slowing. We start asking ourselves, why is the growth slowing? Why is Pepsi destocking inventory? What is keeping Pepsi on board in the long term anyway? Those are questions that are kind of still unanswered. Could go either way, but as an investor, I'm not trying to play a stock for a month or 3 months. I want to be around for 3 years, and there's better opportunities, in my opinion.
I couldn't help to add that when we look into insider selling, I guess this is one of the key takeaways from investing in Celsius, is that when we look at management teams, when they think a company is undervalued, they would normally buy their own stock. There are lots of reasons to sell a stock, but for a management team, there's one reason to buy. There's a saying for that. And I think based on my past experience, we often don't look into why does the stock sell off like 10%, 20%. We don't spend enough time looking into the reasons why it has sold off so aggressively. And I think that was one of my investing takeaways that I've learned over the past couple of years is to really look into it because there's so many external noises impacting your thought process and to influence you to buy. So that was one of my takeaways that I wanted to share as well. So Simon, thank you so much for doing the right thing to update your view on Celsius, the entire energy drinks industry. I'm personally curious to know whether you're going to still open another can of Celsius.
I will. No, I still have them in the fridge. I'll have one every other day, every third day. I'm drinking coffee this morning. I think last time we chatted, I had a Celsius front and center, but maybe that's even a bias in itself, right? I'm bearish on Celsius for this conversation, so it's back to coffee this morning.
So, Simon, any investing takeaways that we should take note of this year?
Well, Powell finally has given everybody the sigh of relief that we all wanted to hear, which is he says, rate cuts are on the table. The time is now. We've all been waiting for that for a long time because it's been a funky macro. And I think that, maybe the takeaway, if we can frame it this way, Kelvin, is that investing is kind of a combination of three principles. It's fundamentals, finance, it is risk, and it's luck. The fundamentals piece, we spend a lot of time talking about. We see cash flows growing, we see revenues growing. We can do a lot of analysis on the stuff that's out there. And then you kind of blend that with valuation and you figure out how risky do you want to be? The second piece, right? Do you want to go out and find a growth company that could drop 50%, but you could gain 200% on? Or are you much more comfortable investing in the Magnificent Seven or the S&P 500, which is a much safer bet? And then even if you want to go risky or go after higher growth, based even on fundamentals, there's still a luck aspect. We cannot deny that there are years like 2021, which is just phenomenal. The best case scenario for investors where there's zero interest rates, everybody's coming off of stimulus checks, and the economy is doing quite well, all things considered, for the stock market. And then 2022, the very next year, and just you can't find a stock that doesn't get punished for missing earnings by 1 penny on their quarterly results for the following year. There's just something about the macro economy that's just hard. It's just hard to decipher what all's going on. And I don't think we should try to, you know, overanalyze every time that Jerome Powell sneezes what's going on with the macro economy. The economy is going to do what the economy is going to do, and the Fed's going to react to that appropriately. But they're not even going to get it perfect, right? If they were going to get it perfect, we wouldn't have to have these spikes up and down. But the good news is you don't have to. And if you find really good companies that are vastly undervalued, even with the spikes up and down in the economy being fantastic or not so fantastic, over 5-year periods investing in stocks, you tend to do well if you invest in good stocks. And that's what I'm always looking to do. I always come back to, long-term investing. It's not a cop-out. It's not an excuse about missing a quarterly results or anything like that. It just takes time for smart business people to enact strategies, knowing that they're under the same pressures that we are. They can't predict the future, what's going to happen next week or next month. But if they're doing good things and they're compounding wealth over time, that works to the benefit of investors. That's why I always maintain long-term investors have got the edge over day traders or AI algorithms or, everything that's going on in the market on a day-to-day, hour-to-hour, minute-to-minute basis. Very hard to win that game, but very few people are willing to be patient and look at what's going on in the bigger picture. And that's where I think that we maintain our edge as individual investors. It's exciting to me every day to go out and find those opportunities.
While you're explaining the investing takeaway just now, I had a few questions running through my head because to be a long-term investor, especially in times like this in today's market, I think that having a healthy cash position enables you to think long-term. How do you see the rebalancing of the market in terms of the cash to equities portfolio position?
I would say it's always personal, Calvin. Do not lose sleep at night. And this is why this is an answer that has to be individual, because let's use Nvidia as the example, right? Nvidia has been one of the best performing stocks for a long time, and people have been claiming Nvidia was overvalued for a very long time, right? So if you are in retirement and you need the money and Nvidia runs up, you probably might be tempted to sell that stock. When you see that it's up 100, 200, 300, 500%, you might want to take those gains, because if you're not have a steady income coming in anymore, you might want to say, okay, wow, great. That's a new boat. I can sell, I can pay off my mortgage now. I mean, that's an individual consideration I can't make for anyone else. But on the other hand, if you don't need that money right now, if you say, I'm going to invest in NVIDIA and I'm going to leave it for 5 years, no matter what happens, you're much more comfortable with the stock going up and going up as NVIDIA is performing well. By the way, it's hard to say that NVIDIA is overvalued when you look at its sales growth and you look at its cash flow generation, right? It's not like the business is failing and the stock's going up. It's completely knocking it out of the park. So in that case, maybe it's okay to let it ride and be like, you know what? I'm not going to be tempted to sell this at 100 or 200% gain, because you don't want to kick yourself when you miss the next 200% gain as well. And so it's an individual thing. I tend to personally let it ride. I don't have a max percentage that I want to cap myself for any individual position. I think that personally, it's too hard to try to follow 200 stocks. I tend to like to kind of have a large peripheral vision and then bring it down to what are my top 5 stocks this month that I would buy right now. That's why 7 Investing does 5 best buys, not 200 best buys.
Well, Simon, that wraps up the podcast episode. But before I fully wrap it up, I do want to give you an opportunity to tell us more about 7 Investing, or how we can find more information about 7 Investing or find you. So take it away.
Thank you, Calvin, for having me on the show. I always enjoy these conversations. You always ask such good questions. It's kind of exactly why we started 7 Investing in the first place, was to get behind just the earnings numbers and just get behind the news stories, headlines, and like what is really going on with these businesses. How did the energy drink market start and how does Celsius figure into that? Times, however, other many companies we want to look at. And so 7investing.com is our website. If you go to 7investing.com/subscribe, use Goliath, the code that we have in partnership with you get a discount on the annual option. I'd encourage everybody to come at least check it out. We give the first week for $1 just to check out everything that we have. And you can look at the whole scorecard and kind of figure out what kind of investor are you? This isn't just about we pitch a stock and then that is just the only stock to buy right now. It's kind of, are you an income investor? Are you a risk-taking investor? Are you a growth investor? Are you more of an undervalue valuation investor? There's a bunch of different ways to invest in the stock market. And we've done diligence on nearly 200 unique companies. We've cast a very wide net. We've looked at a lot of different types of companies, a bunch of different industries. But at the end of the day, it's my job to really figure out what are the best five every month to put on the plate for you to consider.
Awesome. So check out Simon Investing website and Simon's X profile. He always shares a lot of interesting insights and articles. So do check it out. Simon, thank you so much.
Thanks, Colin. Thanks for having me.